Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas president and head of portfolio strategy, Nicholas Bohnsack, to talk all things markets. But first, Nick, how are you doing this morning?
I'm doing very well, my friend Ross. It's good to see you, bud. How you doing?
Yeah, doing really well. No complaints here. Plenty to talk about with you. From where you sit, you get a good view of kind of the whole picture of it. And I want to start with your all's market call over the last 12 to 18 months, which is this idea that sticky inflation, structurally higher interest rates, and until now, a lack of kind of an organic driver of growth to move the markets higher would eventually weigh on stocks. And it took some time for that to play out, but we are kind of in a soft patch here. So I want to turn it over to you to get your updated kind of 30,000 foot view on markets in the economy.
Yeah, I appreciate that. I mean, listen, this forecasting business is tricky, and when you can, kind of get the building blocks right, and you miss it on the timing, or you get the timing right, and you miss sort of the general direction. It can be very frustrating. But I think our approach has always been sort of return when confused, return to first principles, and sort of look at the sort of the structural building blocks for the economy and for the capital markets. And earnings lower and interest rates higher is not really a good recipe. So as the third quarter plays forward and you get a Fed that remains, as you mentioned, skittish about structural inflation and really looks at trying to arrest that back to levels that are acceptable to policymakers, and at the same time you've got some companies that appear to be flagging on the corporate profit line. The market's going to react to that, and generally not in a positive way. And this is, as you've mentioned here with organic drivers of growth, really the focus on why we need something to hang our hat on. If we're not going to have policy as a stimulant, then you really need to have something tangible. And we just haven't been able to identify that. And so while it took longer than anticipated, now we're unfortunately getting a little bit of our own medicine.
Well, and you mentioned the corporate earnings piece of this because we focus so much on the inflation, the rates, the kind of top-down macro drivers. But a big piece of the consensus narrative, especially for 2024, is that this reacceleration in earnings growth. You all have a slightly below consensus view on earnings, and it has been a mixed earnings season so far. There's still plenty to go, but as we sit today, what's your view on the earnings season and how that impacts markets from here?
Yeah, you're generous to say slightly below consensus. I think we're decidedly below consensus, and our concern point is principally focused on the consumer and on big tech. And the Magnificent Seven have sort of started to report, and as you mentioned, it's been a mixed bag certainly there. The consumer will be later in the earnings season, and with energy prices higher at the pump and industrial energy prices higher throughout the economy, there is some concern that the costs that corporate operators are digesting will start to have an impact on the bottom line. What's interesting about this third quarter reporting season, however, and how it differs from the reporting seasons that have come before it over the last year or so, is that the street has always anticipated that next quarter will be where this cycle bottoms, and that's not true this time. This time around, they're saying nope, the third quarter is the end of the road, and from here on out, earnings will be more positive. So we're going to pay particular attention, Ross, to the costs, particularly on the labor side, and where there is margin pressure and margin contraction. We'll be watching to see whether corporate operators remain as generous as they have been with labor, and ultimately may, and unfortunately, start to announce some layoffs to try and stem the tide as it relates to margin. But the third quarter is every year the most important earnings quarter because it really sets the bar for the next calendar year, in this case 2024. And this one is equally important because of just a number of big macro issues that we have to digest, not the least of which is the costs that are coming through the system because of inflation.
Right. So higher interest rates, sticky inflation, softer corporate earnings, all paint the picture of why you all are more cautious on stocks right now. But even amidst that backdrop, there's pockets of opportunity and pockets you like. So I wonder if we could end with talking about a sector or two that you all are a little bit more bullish on as a place for people to play offense in kind of a more defensive environment.
Yeah, one of the things that people have to remember is just because you may have an overarching concern about the economy and the market, is there's always some area of opportunity because the economy offsets one with the other. So areas that we like, if we're concerned about costs in the general economy, we like a sector like energy, which has pricing power and is able to very easily pass that on to its consumers. And so energy, which went through we'll call it a soft patch earlier this year, beginning of 2023, has sort of seen a little bit of a renaissance as energy prices have backed up, through the 80s and now into the 90s, and that's going to have a very positive impact on corporate profits for the energy patch. But at the same time, you're seeing a little bit of concern about the profit profile and sustainability of some of the electrical vehicles and renewable energy sleeve. And so that just gives a little bit more sort of positive underpinning to the energy sector. Another sector that we like here, particularly because we're not in a recession, we may be stumbling toward one, we maybe see some sluggishness in the overall economy, but the industrials have been a sector that remains pretty vibrant. Last few weeks, they've had a little bit of a rocky patch, largely on account of some uncertainty around what's happening in Washington and the budget. But when you think about the national defense and you think about industrial companies, particularly around the areas that are incumbent in deglobalization, resource utilization, reshoring, the national defense, IT procurement, those are all areas that are very bullish in our view, for the industrial sector. So energy and the industrials from our vantage point are two areas to take a second look at if you don't have enough exposure in your portfolio.
Great. Well, Nick, thank you so much for the time. We really appreciate the insight as always, and hope to have you on to talk again soon.
Appreciate the time, Ross. Thanks, bud.